Srikrishnan H, the MD and CEO of Karnataka Bank, who's joining us on the show now. Mr. Srikrishnan, thank you very much for your time. Your loan growth this quarter has been relatively slower than the overall banking sector credit growth which you observed. Talk to us about what has been the reason behind this slower growth, and is it a conscious calibration which you're undertaking and it is likely to reverse going forward?
So as far as Karnataka Bank is concerned, there was a conscious call made in a couple of quarters before that, some of this high, cost deposits as well as some not so, good yielding loans were retired. And this was a very conscious call whereby we actually calibrated this a little bit. But the following two quarters, which is the last quarter Q1 FY24, and the next quarter, which is currently underway, in both on an annualized basis, we have hit a target growth of 10%, and that's something which has been the guidance given to the stakeholders also. So it is not as if we are really under, but we will pick up soon because there are 2-3 engines that are going to be firing. Because one is the branch engine. The second is a sales engine that, we are wrapping around all of our branches with DSAs and sales staff. And that would be particularly aimed at gold loan, Agri, as well as personal loans. And the third one is a digital part. So we have digitized at least about, 30 to 40 customer journeys. And that, in fact, the flagship product, the hero product there is our consumer loan journey, where it is near 100% digital. So we believe that, the offtake will be there. So the following quarters from now, we believe that when we have all the 3 channels firing on the sales side, we will be in a better position in terms of the growth and catching up with the market on this, on the advances side.
Flashes.
Right, sir. And also, you have guided for that 18 to 20% growth in 3 years. You have spoken about some of the levers which will get you there. Talk to us about how the growth will shape up in FY24 and FY25 before you get to that 18 to 20% run rate as well.
The current growth annualized is about 10%, and we aim that, it would be the exit for this year would be about 12 to 13%. And then thereafter, we will catch up the year 1, year 2, and year 3. So we believe that year 3, as I have mentioned the guidance, we would cross 100,000 crore from the current 63,000 crores mark that we have. So which means that we have to grow at a rate of about approximately 18 to 19% on a compounded basis.
There is competition on the deposit front as well, which the entire industry and the sector is witnessing now. Would you be able to hold on to margin in this kind of scenario? And it's on the upper end of your guidance band. How should one look at this margin guidance which you've shared going forward?
Yeah, that's a great question. So as far as Karnataka Bank's history is concerned, in the last 2 quarters that we have demonstrated as far as the NIMs are concerned, the NIM guidance has been 3.5 to 3.7, and we stay with that for 2 reasons. One is that we believe that the deposits have peaked out, and in terms of the rates, and we believe that we will be able to get more low-cost deposits, whereby we should be able to grow, but grow very productively. The second part is the advances side. On the advances, now while there is a definite change, but then we are benchmarked to the T-bills, and we are more benchmarked to the current kind of market rather than the repo. And this is a conscious call that the bank has taken, particularly in line with the interest rate cycle. Now, as a result, we will be able to price the assets also in a way. And the NIM guidance, which is 3.5 to 3.7, is something that, we are very confident of meeting. Now, as far as the cost of funds is concerned, now there are some quarters whereby there will be a 20 to 30 basis points increase. But then we would very much be in the region of about 5, or let's say 5.1, or it could even come down to about 4.8 to 4.9. So the guidance here has been that we would always be in the 4.7 to 5.1 range as far as the cost of funds is concerned. So as a result, we are running a very, very lucrative business. And the real trick now is to increase the volumes on both sides. And that is exactly what the bank is focusing. So the bank is turning out to be a digital bank of the future with a lot of initiatives that are happening.
Also, when we're looking at it, your return on asset target guidance is at 1.2 to 1.4%, but you have clocked of an ROA of around 1.47%. So, what, in your view, has led to this ROA contraction?
I think the ROA is at 1.2 is quite healthy. 1.4, is there because 1 or 2 quarters we have had some good quarters. But we believe that the investment that we need to make in front-end technology, there's a lot of people, that we need to make changes right from leadership level as well as the national, regional level. So there are certain, plans that we do have, which essentially are all very operational in nature. It's not as if we need to do a lot of investments in technology baseline, because the baseline technology for digital, the baseline technology for the core banking, and the rest of the other surround technologies are all in place. So we do not require, real, growth capital for technology investment. It's only for an operational part, the people, and more importantly, to grow the book that, we need to be funded. And that is something which is a constant effort. At this stage in the bank, we are quite healthy on the CAR also, since you talked about the metrics. But as you know, that as we grow the asset book, there is an impact on the CAR, which is a healthy impact. So we need to make sure that, it is not just internal accruals, but there's also an opportunity to kind of make sure that there's a funding that the bank has to take a look, because this is how banks grow. And we believe that we are on the right path as far as the growth is concerned.
Right. All right. Thank you very much for joining us, and good luck for coming quarters. We'll take a short break on